that has come out with its numbers, and we have the management also joining in. It's a good Q3 earnings that we see coming in from SmartWorks. In fact, robust margins, and we do see we will be joined by the management to give us guidance on the growth roadmap ahead. Harsh Binani, who's the co-founder and ED of SmartWorks, is now joining us. Hi, Mr. Binani. Thank you so much for joining us. Well, your profit has turned positive, after a loss of for the several quarters in this growth momentum. Is this growth momentum sustainable? What is the outlook for the remaining FY26 and the full year of FY25?
Good morning and wishing all the viewers a very happy new year. It's a very important and clear inflection point for SmartWorks, the Q3 results that we've just announced. This was our strongest quarter to date, where growth, margins, cash flows, and returns have all converged together, which clearly indicates to you that SmartWorks is now structurally entering into a compounding phase. As you would have seen that the headline numbers are very strong. Our revenue grew by more than 34% year on year, with double-digit growths quarter on quarter. Our EBITDA reached an all-time high of 85 crores. And particularly what's most interesting about our results this quarter is how our OCF to EBITDA, our cash flows has again gone back to greater than 1, clearly indicating the strong cash flow nature of our business. What has been driving the results is largely our large enterprise demand, where more than 90% of our revenue comes from large enterprises, which includes global MNCs, large listed companies, and Indian conglomerates. So we are seeing a very strong growth outlook ahead. Our FY27 and 28 supply is already locked in, and particularly with a lot of influx of GCCs and multi-city expansions that we are seeing from our clients, we expect a very robust quarter ahead with expanding margins. And most importantly, our return on capital employed has also seen a jump by more than 800 bips, growing from 14% to more than 21%. Lastly, to your question around us turning Ind AS profitable. So let me just clarify that the company has been profitable for the last 4 years, and we've also paid income tax. The good news now is that Ind AS, basis which we are accounted, where the interest cost and the finance costs, which are largely non-cash in nature, more accounting, they are converging now to our actual profitability, indicating that the scale economics is now finally catching up, and it's a good milestone for us. However, having said that, we've always been profitable and cash flow accretive.
Well, yes, that's with respect to the accounting standards that we wanted to know a bit more on that. But Mr. Binani, the IT clients now contribute to 38% of your revenue. What's your plan to diversify this going ahead? And which segments are you finding good demand momentum picking up right now?
Sure. Over the last 3 years, progressively, our non-IT base, which particularly includes manufacturing, logistics, healthcare, and BFSI, has been taking a large growing share of our client pool. ITITS continues to remain very robust. What has been largely also driving a lot of incremental demand in the last 2 years is GCCs. So as we continue to scale up and grow, we expect that GCCs and a lot of non-ITS sectors are going to be driving a lot of demand. And particularly what also makes this de-risk for us is that not only is our client pool diversified across sectors, but our overall portfolio concentration risk has also been coming down in spite of the fact that our deal sizes are continuing to go up, which indicates to you that the multi-city farming engine which we have developed continues to operate in a very robust fashion. And at this point, we are extremely excited about the large opportunities that we are continuing to see with GCCs and the diversification that we've done. Our positioning has been very clear that we are a pan-India infrastructure partner. And therefore, when you look at our metrics around multi-city revenue, 30% of our revenue actually comes from multi-city revenue clients.
Right. Harsh, also tell us how much Capex have you utilized for 9th month FY26, and what is the Capex outlooks for FY26 and FY27 as well?
Certainly. Our balance sheet strength has continued to go even further up in the last 9 months since we've done the IPO. And we are starting to see the benefits both on the demand side and the supply side, where the flywheel is starting to take off meaningfully. During the IPO and the last 2 quarters, we've been always indicating that our business is a cash flow focused business. And we are now entering a compounding phase where our entire Capex is going to be self-funded. We are yet to utilize all the capital that had been raised during IPO, because the prior investment that we had done before IPO, which is just 500 crores, continues to generate very healthy cash flows. And the new deployment which we have done post IPO is now starting to enter into maturity phase. So far in the 9 months, we've done close to about 200 crore plus of Capex. Going forward in the next 2 years, we've guided that we'll be adding about 2.5 to 3 million square foot every year, which will largely overlay with about 350 crores to 400 crores, both of which will be financed completely internally, and we will not require any other external capital to maintain the 30% growth plus that we are forecasting.
All right, we look forward to that. But with this, Mr. Benani, we'll let you go. So good having you on the channel today. Thank you so much for our time and all the very best for the upcoming earnings.
Thank you so much.
All right, so that was the management of SmartWorks talking to us about the company, that the reported numbers, how they have been looking like, and going ahead, what's the outlook. GCC is something that has been showing very strong traction when it comes to SmartWorks, and the stock is also seeing on the recovery mode. But with this, viewers, it's time now to slip into a very short break. Don't go anywhere. We'll be right back on the other side.